If you are feeling pressure of high mortgage rates, believe me, you are not alone. This increased household debt surely is weighing heavily on our finances. Hi, my name is Sunny. A quick like, share alongside smashing that like button will be highly appreciated. Huge number of mortgages in Canada are set for renewals, that too within the next 2 years. One in every three Canadians have a variable rate mortgage, which are affected negatively when rates are on the rise. I believe people bought or refinanced their houses at historically low rates, meaning housing market was at its peak when they entered. Now when rates go up, large portion of their disposable income is going towards mortgage repayments. Increased defaults in auto loans is a clear indication that people's finances are too stretched. Consequently, any increase in payment is going to put Canadian households at a much increased financial risk. Reset of Canadian mortgages at higher rates is the biggest challenge we all are facing. Consequently, more disposable income is going towards paying off loans at a higher rate. Therefore, tightened monetary policy of Bank of Canada indicates tough times for Canadian households. Post pandemic, when rates were ultra low, household debt ballooned, majority of it was mortgages. In the backdrop of rates having gone up by about 3%, increased repayments could be devastating for many families. I believe rates will remain elevated and times of cheap money are long gone. Right now, people are spending most of their disposable income, including savings, just to keep afloat financially. Canadians with mortgages have been adjusting their spending as rates are on the rise. You are most vulnerable if your mortgage is up for renewal now. When you have to shell out more for repayments, people's spending habits are bound to change. Consequently, a precautionary pullback in spending by households eventually is going to cause a negative cascading effect on the Canadian economy. All this is clearly evident both from GDP numbers as well as falling gas prices as there is lower demand in the economy. Surely, inflation will come back to Bank of Canada's 2% target range, but not without collateral damage or possibly a recession. Most economists believe Bank of Canada is done raising rates. Normally, it takes 12 to 18 months for effect of rate hikes to trickle down in the economy. With economic slowdown already happening, policy makers I think will take wait and watch approach. Tight Canadian job market also gives an indication that rates might have peaked. Another big variable is US Fed rates policy as our economies are intertwined. My concern is divergent rate hikes and higher house prices. Therefore, a correction is overdue as we have the most overheated real estate amongst G7. Economically, we could be heading for challenging times in coming months. For sure, recent increased mortgage payments are forcing many Canadians in a tight corner. Consequently, disproportionate spending of disposable income not only reduces discretionary spending but brings economic challenges for our economy. I believe that is what we are seeing these days as far as demand and in the economy is concerned. Don't get me wrong. Some might use their savings to pay off high cost debt or pay off mortgages, but those are relatively in minority. Downsizing could be another possible option, but there is lack of demand. In my limited wisdom, downward pressure on house prices is inevitable once this froth and excitement built around real estate really settles down. Mortgage default happens in most cases when you borrow more than your cash flow. Increase in default provisions by banks indicate lenders are worried about rising mortgage delinquencies. Surely, this number is not very high, but because most renewals are yet to happen. I believe Bank of Canada is aware about this coming economic tsunami, therefore they might adjust their monetary policy accordingly. I believe we have reached peak of rate tightening cycle. Rate reductions will happen. Amount and duration are debatable. Bank of Canada has maintained its overnight rate at 5% in line with most economists. Apparently, there is no excess demand in the economy in most sectors. I believe rates will remain at these elevated rates for the next few quarters so that inflation is crushed completely. Bank of Canada will keep an eye on inflation and the job market, and I'm sure will tweak it either way if the situation so demands. External factors like US Fed rate which needs to be taken into account, otherwise our Canadian dollar might get devalued. Now for real estate investors, I think good times are behind us as times of exuberance are long gone. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal financial situation, and don't forget to do your own due diligence. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.